Today I'm gonna review this corporate finance 2 class. Um, so if you recall what we have learned after the middle term, we can actually divide the contents into 3 parts. The first part is from chapter 12 and chapter 13. It's still about using campaign model and calculating the cost of capital. And then we go into chapter 17 to chapter 20, which is the second part. The second part is about how to choose the optimal capital structure. And then the third part is about option. Basically, we have 2 chapters, chapter 14 and chapter 15. So let's first start from the first part. So the first part has 2 major topics. The first one is capital asset pricing model from chapter 12. And then the chapter 13, which is about multiple factor model and some other models to calculate the cost of capital. The chapter 12 is really about how to implement the capital asset pricing model to estimate the cost of capital. So in terms of implementation, there are several components. The first one is about understanding the market portfolio. Remember that the definition of market portfolio is like this. It is really the collection of all securities in the market. So you can see that this definition is quite abstract. And to make it concrete, we use market proxies to represent market portfolio. And you can imagine that depending on the market, right, you could have different kinds of proxies for the market portfolio. If you're in Canada, then maybe you could use this Canadian TSX composite index. And if you're in the US, then you would use SP 500. And then we talk about how to determine the risk-free rate. Often when people talk about risk-free rate, it's as if there is really a very clear rate you can use, right? 3%, 4%, or 5%. But in reality, it is not. So, practitioners, they would tend to use long-term treasury bonds, long-term government bonds, and they will use the rate on these long-term government bonds as risk-free rate. And then we discussed how to estimate the market risk premium. There are basically 2 ways. The first is to use the past data. For example, if you want to look at the past 20 years of average market returns, then you could use this average market return as the estimation of the market risk premium. But you can see that because you're using the past data, so what you really got is information from the past. And we all know that past returns do not indicate future returns. So we have the second method to calculate the market risk premium. Because in essence, right, when you're talking about CAPM, this market risk premium is defined as the expected return on the market minus the risk-free rate. So it's very important for you to correctly estimate the expected market return. So if we use the dividend discount model with constant return, then we could somewhat be able to back out the expected market return, right? The idea here is quite Simple. So let's say if the current market index is given by P, and then the market dividend is given by D, and then the constant rate, let's assume it's given by G. And according to the dividend discount model with constant growth, then we know that this formula will be correct. And then this will basically tell us R equals D divided by P plus G, right? So basically using dividend yield and the growth rate, we can estimate the expected market return. And then we will use the CAPM model to estimate the debt cost of capital. And the caveat here is when you're using CAPM to estimate the debt cost of capital, the beta will be the beta of the rating category, right? So basically, if you're looking at a debt, and this debt has a rating of, let's say, AAA. And then when you're trying to estimate its cost of capital, then you will actually use the beta of AAA rated category. And then there's a second way of calculating the debt cost of capital. Basically, you want to adjust the yield to maturity by accounting for the possibility of default and the expected loss rate. And then using this adjustment, you can find out the debt cost of capital, right? So you can see that this formula gives you how you could adjust from yield to the debt cost of capital. And then after being able to calculate the equity cost of capital and the debt cost of capital, we could calculate a project's cost of capital. In terms of this, the basic idea here is this: compare. Basically, you want to compare your project with a similar firm. And then if this firm is similar, right, you can basically use the data from that similar firm, which will help you to estimate your project's cost of capital. In terms of formulas, we discussed basically, I would say, 3 formulas. The first one is to calculate the unlevered beta. And then we also discussed how to calculate the unlevered cost of capital or the asset cost of capital, because you know these two guys are basically the same. So, oops. Not beta here. And then the third formula is about calculating WACC when there is tax. So here TC is the corporate tax rate. So how do you get these formulas? Well, the basic idea is you can basically consider the firm's asset as a portfolio of debt and equity. Then we have learned that the portfolio's beta is the weighted average beta of individual assets beta. So you will get this first formula. And then we also learned the portfolio's return is the weighted average returns of individual assets. So you will get the the second one. And then if you think about that, with corporate taxes, debt will provide corporate tax shield. So if you're thinking about a world with corporate taxes, then you will essentially think about the after tax debt cost of capital. And you can see that 1 minus corporate tax rate times the debt cost of capital gives you the after tax rate. So you can see that this will give you the formula of calculating WACC. And then we move to chapter 13, and you can see that if you read the textbook, chapter 13 is quite long, and it's much longer compared with our lecture note. So essentially, the lecture note only focuses on the FFC four-factor model. So here for this chapter, you need to understand how to use this factor model to calculate the cost of capital, right? So basically, under this FFC four-factor model specification, cost of capital is calculated as it's given by this. Okay, I forget what's the name for this. I think the textbook used, prior 1 year return. So it's really about plugging numbers, but I talk about several caveats, right? So first, you have to be careful that for the first factor, you have this minus RF here. But for all these three factors, we don't need minus RF, right? So we don't need this. And then the second is about the matching the time horizon of different returns, right? So if the problem tells you this is every month return and this is annual return, then you have to adjust this. Let's say you have to adjust this guy, annual risk-free rate into monthly risk-free rate. Then you can use the formula to calculate monthly expected return, right? Okay, now we go to the second part, which is a very large part, and we spent a lot of time on this. It's essential about how to choose the optimal capital structure. And this part has two sections or two components. The first component is how do you exactly choose debt versus equity? And then the second component is about how to choose payout. And you can see that the majority of the second part is really about how to choose debt versus equity. And in a very summary way, you can see that if you're having a perfect capital market, then choosing D and E does not really matter because the firm's value would be the same, right? So this is basically the famous MM theorem. And then when we move to the more realistic case, that is when we are thinking about the real world with corporate tax and personal taxes, you can see that, yeah, it does matter. So this is the basis of the trade-off theory. And then we move on to the more advanced case, that is, we think about the information asymmetry between firms and investors. And under this information assumption, we have this pecking order theory. And then about how to optimally choose the firm's payout, our discoveries are, first, it does not matter if it's a perfect capital market. And then it will matter if we have an imperfect market with taxes. Okay, now let's see exactly what we have discussed in these chapters. So first, for chapter 17, it's really this foundational basic chapter because chapter 17 assumes perfect capital market. So it's actually, it's obviously a fictional case because in a perfect market, you don't have taxes and you don't have any transactional costs. However, this really gives us this perspective on what would happen if we have this perfect world. So our main finding is MM theorem. And MM theorem has two parts. That is MM proposition 1 and MM proposition 2. MM proposition 1 basically says firm value does not change with your capital structure. That is A equals D plus E. And we know that no matter what is your debt versus equity, this A, that is the value of the firm, would stay the same. And then we talk about this very important application, leveraged recap, right? Leveraged recap basically refers the case that the firm borrows money and then the firm would use the money to buy back shares. So this is a recap because it basically reduces the amount of equity in the firm and it increases the amount of liability in the firm. And the basic result of this application is firm's value will stay the same, and importantly, firm's share price will also stay the same. And then we discussed MM proposition 2, which is derived from MM proposition 1. And MM proposition 2 is about the cost of equity and the beta of equity. And the answer is the cost of equity increases with leverage. Why? Well, that's because beta of equity increases with leverage. And in terms of formula, we learned RE equals RU plus D divided by E, RU minus RD. Or beta E equals beta U plus D divided by E, beta U minus beta D. And our focus is really on this guy here. That is the fraction of debt versus equity. Or the ratio of debt versus equity. And you can see that if this ratio increases, then the cost of equity will increase and the beta of equity will also increase. And again, obviously, these two results are quite related, right? Because according to capital asset pricing model, if beta is higher, then the cost of capital should be higher. And then we discussed the more complicated case, that is when there are taxes. We first only consider the effect of corporate taxes. The very basic step here is you need to understand how to calculate the interest tax shield, right? And we know that the interest tax shield equals the corporate tax rate times interest payment. And interest payment equals debt times interest rate, right? And then we proceed to discuss the valuation of interest tax shield. Of course, we want to understand this because we know that the firm's levered value equals the firm's unlevered value plus the value of debt. So you can see that understanding the present value of, I should not say the value of debt. So plus the present value of interest tax shield. So you can see that understanding or valuing interest tax shield gives us a pretty good idea how the firm's levered value will change. And we sometimes would also use the difference between levered value and unlevered value to calculate the value of the interest tax shield. And to be more specific, we discussed three cases. The first case is constant interest payment. This is easy, right? Because if interest payment is constant, and we generally assume the corporate tax rate stays the same. So you can imagine that interest tax shield will be constant across different periods. So depending on how many periods, if you have infinite periods, then you can use perpetuity formula to value the present value of the constant interest tax shields. If you have a limited periods, then you will use the annuity formula. Right? And the second case is valuing the interest tax shield with permanent debt. And the formula is given by corporate tax rate times the amount of debt. And then the third case is about the fixed debt equity ratio. So this is a special case because we assume debt equity ratio is fixed. So why do we want to make this kind of assumption? Well, because if debt equity ratio is fixed, then WACC, that is weighted average cost of capital, is fixed. So now under this assumption, the interest tax shield would be given by the value with leverage minus the value without leverage. And how do you find out the value with leverage? Well, it's basically the firm's cash flow divided by WACC minus the growth rate. Now, how do you find out the firm's unlevered value? Well, it's pretty much corporate finance. So you will use the firm's cash flow divided by WACC without tax, right? So let's call this WACC no tax and minus G. So this is the idea to back out the present value of interest tax shield when we have the assumption that is debt equity ratio is fixed. And again, we encounter this application that is leveraged recap. In this case, we will get a different result compared with under the assumption of perfect capital market, right? So the result is if the firm is using leverage recap, then then the firm's value will actually increase and the firm's share price will also increase. And here we have an important question, that is how exactly the firm's share price will change, right? To solve this, we have to understand a basic result, that is the value increase because of the interest tax shield will be captured by all shareholders. To be more specific, will be captured by all original shareholders. So I would say you should be really familiar with this leverage recap application under both cases, right? Either with tax or without tax. And then we further go into the more complicated case, that is there are personal taxes. In this case, we first defined the effective tax advantage of debt. Right. So here the TC is the corporate tax rate. The TE here is the tax rate on equity income. You can consider this as the average tax rate on dividend and capital gains. And this TI is the tax rate on interest income. The basic idea here, or the basic result here is at the personal level, at the individual investors level, interest income has disadvantage in terms of taxes, right? Because generally, tax rate on interest income is higher compared with the tax on equity income. So the effective tax advantage of debt will be smaller when we consider the effect of personal taxes. And then we talk about the case that value the interest tax shield with permanent debt. And the formula here is actually pretty similar to the case when we only consider corporate taxes. When there were only corporate taxes, the present value of the interest tax shield is given by corporate tax rate times the amount of debt. And now, in this case, you would just use the effective rate or the effective tax advantage of debt times this times D, which is the amount of debt. And then we discussed the optimal capital structure with taxes. So our result is, ideally, you will want to make sure the interest payment equals EBIT, because under this result, you're maximizing your tax savings. I mean, this is like pretty obvious, because if interest payment equals EBIT, then your then your taxable income is basically zero. So the government can so the government cannot tax you anything if you have a zero taxable income, right? So I mean, this is obviously the very ideal case. Because of uncertainty in the EBIT, generally you will want to make sure the interest payment to be smaller compared with EBIT. And then we examine the data, right? We want to see whether data is consistent with our result. And we find out it is not consistent with this result here. That is, if you look at data, you can find, I cannot remember exactly the number, but I think the ratio of interest payment in EBIT is about 30%. So it is very slow compared with what predict by the theory, right? So we want to understand why. And then this will give us the trade-off theory. That is, we will consider more trade-offs when the firm is using debt. And the first we discussed is the financial distress cost. So the story here is basically like this. If you use more debt, even though you will get a larger interest tax shield, this higher amount of debt will increase the possibility of default and financial distress. So this will have financial distress costs, which will offset the benefit of interest tax shield and could reduce your firm's value. And then we discussed the agency costs and agency benefits of debt. So in terms of costs, we actually spend quite some time on this agency costs, and we discussed basically three phenomena, right? The first is asset substitution, the second is debt overhang, and the third is cashing out. What is asset substitution? It basically means that if the firm has the possibility of being in default, then shareholders, they will have the incentive to invest in negative NPV project. And this negative NPV project could have a lot of risk, right? So in this case, you can see that even the investment is inefficient, shareholders will still want to pursue this inefficient project. This kind of action will definitely reduce the firm's value. And then debt overhang basically means if the firm has the possibility of default, then even it's a positive NPV project, investors potentially sometimes will not want to invest in this positive NPV project. Again, this reduces firm's value. And then cashing out is a very extreme case of debt overhang. Not only the shareholders do not want to invest in positive NPV project, they will actually want to actively sell the firm's fixed assets. And then we also discussed the agency benefits. So there are basically two benefits here. The first is ownership concentration. The idea is if you're the owner of this firm, right, you can finance your projects with either debt or equity. If you finance it using debt, then the ownership will be 100% concentrated. If you use equity to finance your project, then you have to divide the firm's ownership, and this will have some incentive effect. And you can imagine that if the ownership concentration is higher, then the managers, they will actually work harder and they will consume a smaller amount of perks. And then the second benefit is about reducing wasteful investment. This one is based on the free cash flow hypothesis, right? It basically says if the firm has a lot of free cash flows, the managers, they will want to engage in wasteful investment. Why? Well, because these managers, they are overconfident, or they have this empire building preference. And if we can use debt, then this will be able to reduce the firm's free cash flow. So this will be able to reduce wasteful investment. And then we will use this following formula to summarize the trade-off theory. What you can see here is we have basically four components, right? So the benefit of interest tax shield and the benefit of the agency benefits versus the cost from the financial distress and agency costs. And then we also talk about the pecking order theory. So this theory builds on the assumption that firms have more information than investors. Because of this, there will be some underpricing. That is, if a firm issues equity, then this firm is considered as a lemon firm. So because of this underpricing result, firms, they will prefer to first use retained cash, then debt, and then use equity as a last resort. And then we talk about payout. We first talk about, if you talk about payout, right, there are basically two ways for the firm to pay out its cash. The first is to use dividend. The second is to use share repurchase. So our first task is to understand whether the firm should use dividend or use share repurchase. We started with the basic benchmark case. That is, we assume the market is perfect without taxes. The result is, well, it does not matter. Again, because this is a perfect market, right? So these kind of choices really have no real effect on the firm's value. So it does not matter. However, if we consider taxes, then because dividend tax is higher than capital gain taxes, so if the firm wants to save its investors' taxes, then firm should never pay dividend. However, if we look at data, we can find out data is not consistent with this result, right? In reality, a lot of firms were paying dividends and they are actually continuing paying this dividend. So why? Well, the explanation is the tax clientele effect. Basically, even on average, dividend tax rate is higher than capital gain tax rate. But in reality, we have a lot of investors. They actually don't pay taxes, right? One such example is if you have a tax-free investment account, then in this case, it really does not matter whether you get capital gains or dividend. And then we discussed the signaling theory with payout policy. Basically, there are two kinds of signaling here. The first is about dividend signaling. So the observation is firms they will pursue this dividend smoothing policy. That is, if you look at how firms pay out their dividends, you can see that dividends are generally quite constant, right? You don't see a lot of variations. So the explanation is firms they wanted to use dividends to signal to their shareholders that they have good prospects, right? And you can imagine that if a firm cuts its dividend, then this basically signals the firm has bad prospects. So this will make the firm's share price to drop. And then the second one is about the signaling from share repurchase. The result here is share repurchase signals that the stock is underpriced. So basically, if shareholders they see that the firm is buying back its shares, they will conjecture, well, why this firm is buying back its shares? Well, it's because their shares are underpriced. So upon seeing this, the market will generally give positive response to share repurchase. And last, we talk about retaining cash versus paying out. To be more specific, we talk about retaining cash versus dividend. And then we find out that retaining cash has tax disadvantages. It's actually pretty intuitive to understand this result because if you think about debt, right? With debt, the firm will benefit from interest tax shield. However, cash is essentially negative debt. So if debt has positive benefits to firms, then negative debt will definitely impose some cost on the firm. So that's why cash has tax disadvantage. And there is the additional cost from agency costs. So this is related to the free cash flow hypothesis. If a firm retains cash, then the firm will increase the firm's free cash flow. And according to free cash flow hypothesis, when the firm's free cash flow increases, then there is a higher probability that the managers will actually engage in wasteful investment. However, retaining cash also has some benefit. We talk about two major benefits. The first one is to finance new investment. So in this case, it means if one day the firm suddenly finds out a new investment opportunity, if the firm has cash, then it will not need to raise external funds from debt or equity. So this will save some money for the firm because raising external funds using debt and equity is actually quite expensive. And then the second benefit is about avoiding financial distress. The reason is if you maintain too little cash, then you could have some liquidity problems. That is, possibly you will have problems to meet your debt obligations, pay your bills. So you should maintain a proper amount of cash to avoid financial distress. And in the end, you can see that this whole retaining cash versus dividend argument is really a argument about different trade-offs, right? So it's also about trade-off theory. That is, a firm has to trade off the cost of tax disadvantage and agency costs versus the benefit of financing investment opportunities and avoiding financial distress costs. Okay, now let's talk about the last part, which is about options. And I can understand you might find this part more difficult compared with previous lectures. So, well, I mean, I have talked about this in the final exam guide. Basically, I would say the difficulty level of your final exam on options would be the same as the textbook. And you should focus on corporate finance applications. And I think I have also said you will not get a lot of questions from this part. If I remember it correctly, you will only get at most 4 sub questions on the option section. Okay, so we covered 2 chapters on options. The first is some basic concepts, and then the second chapter talks about option valuation. So first, option basic concepts, right? You have to understand what is the call, what is the put, and what is the definition of exercise or strike price, and how do you calculate option payoffs. These basic concepts are important because when we talk about corporate finance applications, right, you have to understand these basic concepts to understand those applications. So what is a call? Well, call, if you're a call option holder, then you will have the right to buy something at a certain price before a certain date, right? For put, you will have the right to sell something at a certain price before a certain date. And then you have the exercise or strike price. These are 2 different names, but they mean the same thing. For example, if your call has the exercise price of $100 on Google stock, this means you will have the right to buy Google stock at $100. And then option payoffs, I would say this part is pretty important. Basically, if you consider the market price as S, the exercise price as K, then option payoff is S minus K if S is large. Then the call's payoff is S minus K if S larger than K, and 0 if stock price is smaller than K. For put, we will have the opposite result. We will have the payoff as 0 if stock price is larger than the exercise price, and K minus S if stock price is smaller than the exercise price. I hope you could be quite familiar with this result because I would say you can see that for the corporate finance applications, they really rely on this result. So in terms of applications, we talk about basically 2 major results. The first is you can consider equity as a call option. To be more specific, this call option is based on the firm's asset, and its exercise price is the expected date payment, and its expiration date is the debt maturity date. And then we talk about debt. So debt can be considered as an option portfolio. There are basically two results here. You can either use a long position in the firm's asset and a short position on a call option on the firm's asset as the option portfolio. Or you could consider the option portfolio as the risk-free debt and a short position on the put option on the firm's asset. Now, how do you understand these applications? Well, you will compare or you will try to calculate these options payoffs, and you will see that its payoff actually matches with the payoff of equity or the payoff of debt, right? For example, if you consider the first application, so if we consider a call option on the firm's asset and the debt payment D as the exercise price, we will know that this call option's payoff curve will be look like this, right? And you can see that if you're the equity holder, your payoff will exactly be like this, right? Because you can see that if the value of the firm falls below the required debt payment, the firm will basically apply for bankruptcy, and as the equity holder you get zero, right? And then if the firm gets if the firm's value of asset gets above the required debt payment as the equity holder, your payoff will be given by this, right? And then for this argument that debt as the option portfolio, then the argument would be the same. So if you look at this, long position in the firm's asset and a short position on the call option on the firm's asset. First, what is a firm's debt payoff? So if you look at the payoff of the firm's debt, it looks like this, right? So basically, if a firm's value is larger than the face value of debt, then debt holders will get back their money. And if firm value drops below the face value of debt, then these debt holders will just get this amount, right? And then if you think about the option portfolio, long position in the firm's asset, then the payoff curve would be look like this. And a short position on the firm's then a short position on the call option on the firm's asset. Well, in this case, your payoff would be, so if this is D, your payoff would be look like this, right? And then if you combine these two curves, you will get a payoff curve looking like this. So this blue curve exactly looks like the curve here, right? So this tells you that can be considered as an option portfolio with a long position in the firm's asset and a short position on the call option on the firm's asset. And then for the second result, you can do the same experiment and you will find out, yes, this is correct.